This meeting of the Other Post-Employment Benefits Trustees Committee has been called to order. It is 3:32. And with that, Dawn, are you able to do roll call?
Mark Mathers,
Here.
Jeffrey Kurz,
Here.
Mary Lamont,
Here.
Alex Taylor,
Here.
Okay, we have a quorum, and first on the agenda in section 2 of the agenda is an action item. It is possible action to approve the minutes of September 25th. Hopefully you all had a chance to read through those minutes. And heck, let me take public comment before our general counsel gets on me. Do I see any public comment out there? No, I do not. Any changes or corrections to the minutes that anyone had? Okay, I will take a motion then to approve the minutes.
This is Alex Taylor, so moved.
And do I have a second?
Mary Lamont, I second that motion.
Okay. Therefore, all those in favor of approving the minutes of September 25th, 2025, please say aye.
Aye.
Aye. Any nays? Okay, hearing none, item passes unanimously. Okay, next up is for presentation and discussion only. This is a presentation of our unaudited first quarter financial statements for the period ended September 30th. And I think, Mindy, you're going to walk us through that. Okay.
Okay, Mindy Capron for the record. I'm looking at it's 8 technically after the minutes. Has 2.02 up in the top left-hand corner. This is looking at the comparative statement of net position. You'll see that the RBIF account has $22,015,000, and the U.S. Bank has $74,026,000 for a total asset balance of $96,151. The next page is the statement of revenues and expenditures and change in net position ending September 30th. We're looking at an increase of $2,376,000, mainly from the unrealized gain in both RBIF and U.S. Bank. So unrealized means that it's unrealized, so it could change going forward. So the next page is the RBIF account, and it gives you the breakdown of the balance. The unrealized appreciation there is $897,000. And we have interest income, dividend income, you can see there. And the total change is an increase for the quarter of $1,082,000 for the RBIF account. And then I'll switch over to the U.S. Bank. That has an unrealized gain of $1,280,000, and the interest income equals the total change of net assets of $1,294,000. And we did actually have like a $3.1 million cash flow that we moved into the U.S. Bank during that quarter. So our asset balance is up to $74,026,000. Does anybody have any questions?
Okay, seeing none, this is not an action item, just for discussion only. So we will now move to agenda item 2.03. Again, just for presentation and discussion only. This is a presentation and discussion of our quarterly investment fund report prepared by Buckhead Capital for the period ended September 30th. And here to present is Tara Hagan from Buckhead Capital. So we will hear from her.
Good afternoon, members of the board. Tara Hagan with Buckhead Capital. I'm going to start on page 13, I believe, of your packet. Are we on the same? Okay, fantastic. So if you just quickly go to page 14, gives you a little snapshot. You can see the market value as of September 30th. They're getting closer to that $100 million mark. And you can see, I'll go into more detail in the next slide, but you can see the three different accounts and the market value percentages as of 9/30 on that same page. But if we can just go to page 15, just the next page, a little bit more detail on the asset allocation of the portfolio. And just as a reminder, that matching program, that's where we're invested in the zero coupon U.S. Treasuries. Those are laddered out to match those anticipated liabilities for the medical subsidies for eligible retirees. That includes the eligible retirees within the district's plan, as well as the public employee benefits plan. So both of those are included in there. And you can see that they're going to mature every year in May out through currently through 2054. That makes up the bulk of the plan with about 72.5% in the matching program. The excess monies are in the PERS plan, so the Retirement Benefit Investment Fund, or RBIF, as we always say. That, you can see, is getting closer to the 23%. We'll look at that in a little bit more detail in a couple slides, but that 23%, you can tell that those equities have helped. You know, obviously, that gives you that inflation buffer. That is a 60-40 balanced portfolio, 60% equities, 40% U.S. Treasuries. And then lastly is the liquidity. So a little bit more there. We'll talk about that. I think Mindy alluded to it in her last item, but there's $4.3 million in that liquidity account. Obviously, that's just your short-term cash for immediate needs. Okay, next page, just a little bit more detail on the matching account. And I do just want to bring to your attention that $2.26 million unrealized loss. We did have a meeting with the board chair and staff to discuss this a little bit, just to give some context around that unrealized loss. And so we did see, since these were purchased in August of last year, and we have seen that yield curve steepen since that time. And so those longer dated maturity securities, that's where you're seeing some of that difference in the unrealized loss there, is as it's related to kind of that 7-year, I think it's about a 2032 maturity. You're seeing, because of that steepening, that's where you kind of have that unrealized loss, is coming from. Okay, and moving on to the RBIF plan. So like I said, it is a 60-40 portfolio, 60% equities, 40%. Because of, obviously, you can see the equities, because of the performance being driven there, it's a little bit higher right now. It's closer to 64% in the equities and a little bit less, so 38% in the fixed income. This return of the entire portfolio, that's fiscal year to date, so July 1 through September 30th. And you can see that's at 5.2% that the fund has performed. And you can see too, you've seen quite a bit of an increase there in the valuation between 6/30 and 9/30. So you saw a real, pretty good pop there in that performance on the RBIF. And next is just that liquidity. I do want to draw to your attention here, as Mindy alluded to, there was a little over $3 million that came back into the portfolio. So that's invested in a treasury bill. So you can see, if you look at the holdings, it's just included within that matching program. But you'll notice that has a maturity date of June 2026. So just kind of, you can see it's always May with your matching program securities. This one's a little bit out of line there. But it is truly in your liquidity portfolio. So it's a holding. It's a U.S. Treasury holding, but a little bit different than your zero coupon. And then just quickly, if you can turn to page 21, we'll just finish up here. You can see the overall performance of the fund. Now, this is a little bit different because this is calendar year. So a little bit different, your fiscal year on your RBIF, but this is your calendar year. So year-to-date calendar, January through September 30th, you can see almost 8% there with 7.95% rate of return. So with that, I'm happy to take any questions.
I should have asked Rick Combs at our last meeting, but do you know, Tara, they're rebalancing requirements in the RBIP plans, kind of to see that allocation of equities go up to 64%. Do you recall?
Unfortunately, I don't recall,
Yeah.
but I'm happy to find, I know that their policy's online and I can
Yeah.
get that back to you right
Okay.
away. But yeah, I'm not sure where the bands are
Yeah.
that they're gonna yeah.
Okay, yeah, I mean, just for next time.
Yeah, absolutely.
Okay, seeing no questions. Again, this was just for presentation and discussion only, so thank you, Tara. We'll move on then to the next item, which is for possible action. These are audited financial statements for the fiscal year ended June 30th of 2025, and so these have been audited by our external auditor, Crowe. And I think, Mindy, you're here to kind of walk us through some highlights to that.
Okay, thank you. Mindy Capron for the record. I'm looking at, they have it labeled as page 1. It's the independent auditor's report, so had a clean audit. The second paragraph down explains that they've, in their opinion, the company financial statements referred to above present fairly in all material respects the financial position of the OPEB trust as of June 30th. So clean audit, that's always good to hear, and we have some, we've been doing that for a while, so that's good. I'm glad about that. Looking at page 5 of their report, it says financial analysis and discussion. You'll see the total assets increased. I mean, this is back to June, so that's why it's less than what September is, but 93,782,000 versus 2024 was 92,235, so it's going up. And then the last thing I did want to mention, page 25, is that they did not identify, page 24 actually, they did not identify deficiencies in internal controls, so those are the important things that I look for when I get one of these reports, so I'm pleased to report that we're good in that area. So if you have any questions, I'd be happy to answer them.
So Mindy, I'll just ask, there were no large variations to the unaudited numbers that we had reported to the OPEB committee before, in this audited report, correct?
We do have the gross up numbers of the revenues and expenses, but
What-
coming down to the bottom line.
I don't,
We have the, to match the actuarial report, we have to gross up our revenues and our expenses, but the bottom line number comes out to what we had, and the assets the same, so basically, it's the same number.
okay. Okay. Any additional questions? No? Okay, you're making this easy on Mindy. All right, then, I'll entertain a motion to approve those audited financial statements or to accept them for the period ended June 30th, 2025.
Alex Taylor, so moved.
All right, do I have any public comment? Okay, seeing none, do I have a second?
Jeff Kirst, second.
All right, all those in favor say with you and the actuary, Mr. Kirst, but this is an explanation, or attempted an explanation, I think, to your questions. So I'll turn it over to you to discuss or ask any additional questions.
Jeff Kirst, My main question was how many people are eligible for the medical and whatnot? And this explains what that was. In the bulk of the documents that were sent to me, as I read through all of those, it was pretty clear, but there were a lot of references to Nevada revised statutes, and I wondered, are there chances that at the legislature they could change around the eligibilities for the OPEB trust, or is this locked pretty much in stone with the number of people who are eligible for this?
Yeah, so that's a good question. So for employees or retirees who are eligible for the medical subsidies, that's a meet and confer item with the affected associations, WA for teachers and so forth. And so those provisions and restrictions and the end date for eligibility were all established in consultation with those employees associations, or unions, as most people call them, a number of years ago. So that is within our control, within each local agency's control. In terms of the implied rate subsidy that an actuary has to quantify for life insurance, I mean, there are some state laws that come into play, primarily the one that says a local government agency has to set a blended rate for health insurance and life insurance, blended both to account for active employees and retired employees. In other words, we cannot charge a lower rate for active employees based on that experience of active and a higher rate for retirees. That's state law. So if that were to ever to change, then that would open that up to differentiated health insurance and life insurance rates. So that could affect the plan. I don't know of any efforts or desire to change that law, but that creates that implied rate subsidy.
Jeff Kirst, the Teachers Association just ratified their contract, is what they told me when I stopped by over at the school.
Yes.
When they get into the negotiations to put a contract together, can they change the 2006 retiree business, or is that too tough to do, or is it even possible?
Yeah, we want to make sure we stick to the agenda item, which is that calculation of the number of eligible employees. So, okay, all right. Okay, so that was, again, for presentation and discussion only, not an action item. Any other questions? Okay. We will move on to the next agenda item, agenda item 2.06. And this, unfortunately, is labeled for presentation and discussion only, so we'll need to take action next meeting. So that, anyhow, we will have a discussion then on the investment plan and the asset allocation plan, and then document any changes discussed for approval next meeting. So I'll kind of lead this discussion. Annually, the OPEB trust is required to review our investment plan and our asset allocation plan, and a number of other there are a number of other requirements when an entity like our own is kind of withdrawn monies from the RBIF account and has customized investments based on its own risk tolerances and investment horizon and so forth. And so, you'll remember we did that last year, of course. And so we had a PowerPoint presentation here that's in your packet that we can go through, that tries to walk you through the different elements of the investment plan and the asset allocation plan for a discussion. And the investment plan, what we did was highlight in yellow those areas where, you know, we would expect if there was any changes, those sections would be those, would be that would change. But we'll focus on the PowerPoint, again, that tries to walk you through these decisions. And with us, I think online is Matt Bowden of Buckhead Capital, who helped us structure the matching account investments. So if there's any questions there, we have Matt, I believe, online to help answer any questions you might have. So the first page of that PowerPoint is just, again, reiterating that at least on an annual basis, we do this formal evaluation of investment strategies and investment-related practices, and then also an asset allocation review, and that makes sense. That should be done at least annually when we're talking about assets close to $100 million. The next, so is that clear what we're, kind of the purpose here? Okay. So as you all know, in terms of our investment strategy, and this is in the investment plan itself, we employ kind of three different strategies for the three different accounts. The matching program, where we're matching off against projected subsidy payments in the future. And then any amounts over and above those requirements either can go into the liquidity account, where we have very short-term government investments allowed, or investment in the state investment pool, or they would go into what's called our excess monies account, and those monies are right now restricted solely to the RBIF account. And part of this is due to the fact that we do hold less than 100 million, and state law requires us to go to the Committee on Local Government Finance if we want to make any further customizations of investments. Once we cross the $100 million threshold, then this is more within our control and authority just to change as we see fit. So for the matching program, you know, we've gone over this a number of times. Again, the investments are right now contained to U.S. Treasury strips, those zero coupon U.S. Treasuries, where they're, again, no coupon payment, so no reinvestment risk to the coupon payments over time. These basically act like what you would know as U.S. savings bonds. Kind of go through here, kind of the pros and cons. You know, we saw an unrealized loss on these investments. They don't, unlike TIPS, they don't adjust for inflation. But again, we're essentially defeasing a future liability. So it's somewhat analogous, just an escrow account where we say, okay, here's how much we need in each year, and here's the offsetting maturity that will pay for that. So our decision here, and we don't have to, you know, we can wait to discuss it. We can discuss it for each account. It's up to you all. But the decision is whether we'd want to stay with our current asset allocation to U.S. Treasury strips or consider another security. And if we wanted to consider another security, that would require going back to the Committee on Local Government Finance. So that's, we can park that conversation, or we can have a conversation right now. It's up to you all.
I'd be open to having that conversation. I guess my initial, I'd be curious what would be the alternative securities we might consider. I would think that, you know, despite downgrades to the United States Treasury market, it still is the closest thing to a risk-free rate. Going into some more agency mortgage-backed securities, if there's excess yield to be picked up, could make sense. Beyond that, I'd be wondering what else we might consider.
Yeah, so the law restricts us to the kinds of investments that the district or the city or county are restricted to in terms of fixed income here, at least for this kind of an account. So we could buy U.S. corporates, we could buy U.S. agency securities, U.S. agency mortgage backs. We could buy U.S. Treasury TIPS, right? Inflation protected securities, up to 10 years. So we're restricted for like treasuries to a 10-year maturity. So if we wanted to go beyond 10 years, again, we'd have to go back to the Committee on Local Government Finance to ask for a change, because our request last year was to this specific type of security past 10 years. So up to 10 years, we can dabble in any of those fixed income asset classes. Beyond a 10-year maturity, we have to go back to the Committee on Local Government Finance and ask for their approval. So those are our options. I know I'm not giving you a complete list of asset classes, but they're your traditional, safe, AAA rated, fixed income securities, with the exception of corporate notes. So those are options. Want to move on then?
And we could do all of those
Up to
prior to, up to 10-year.
Yeah.
I mean, I guess, for me, it might make sense to try and pick up some of that yield, and/or diversification benefits away from, simple U.S. Treasuries. I mean, just because there's never been a default doesn't mean there couldn't be, although that would probably have ramifications for the corporate bond market as well. I guess the thing that would be helpful to making that decision would be a sense of how much extra yield could be picked up, which might be a question for that Buckhead could
Right.
answer.
Mm-hmm.
Just to weigh the risk reward.
Okay. So maybe Buckhead could report back on that at our next meeting, Tara. And if Matt's there,
Sorry, Matt Bowden's with Buckhead's on the phone, but I guess the audio isn't great, so
Okay.
that's why I'm trying to
Okay.
help translate, but, I mean, he might be able to. But yeah, we can certainly come back with more detailed information about a
Okay.
portfolio.
okay, all right. So the next account, of the portfolio is the liquidity account. This really is intended just to cover any bills that we would have. And, again, this is restricted to just the very short-term, safest fixed income investments that we would make. So either short-term treasuries or U.S. agency securities, the state local government investment pool, or a government obligations money market fund. And again, it's just normally just parking some assets there until we get a bill and to pay the bill. We wouldn't typically choose to leave much money in there. If there's any questions there, I'm happy to try to answer those too. Pretty basic. And then the last account, again, is for excess monies here, somewhat of an inflation hedge here. Right now, we are allowed only to invest in RBIF. And, we had a conversation with RBIF staff last meeting. We've talked before about how that RBIF portfolio is pretty basic, doesn't have exposure to, a number of asset classes that, one might expect when you look at an institutional portfolio. And maybe we can go to the next slide that kind of speaks to that, Don. But again, until we cross over $100 million, we would need to go back to the Committee on Local Government Finance for approval of any adjustment to that. There's lots of options here in terms of if we wanted to go to the Committee on Local Government Finance to shift or lean towards a different kind of asset allocation, getting exposure, for example, to the asset classes they do not. So I'll open that up for any discussion.
Jeff Kirst, when Buckhead comes up with the alternative, I guess, numbers for returns, if something was to be done with this excess monies, let's say a portion of that, would we get a higher rate based on what Buckhead came up? You would go to the, because it's under $100 million, it would have to be approved, correct?
By the Committee on
Committee.
Local Government Finance, yes. I mean, normally we're trying to optimize that risk-adjusted return, right? So it's not about the absolute highest return. And, I want to be clear, Buckhead Capital is a fixed income manager. So we used Buckhead for assistance consultation on the matching program. They do not have equities experience, and so they would not be able to provide any analysis on a different version of an equities or blended portfolio. And that is one of the challenges here as well. I think ideally, if we say wanted to withdraw completely from RBIF, we should procure the services of an asset manager with equities experience for this account, right? And so that would need to be done, at least ideally. So we've got that issue on if we want to have exposure to stocks. Because we're basically just turning that mandate completely over to the RBIF staff and how they want to structure that account
Jeff Kirst, we do have exposure to stocks because
through RBIF.
yeah.
Yeah. So they, in essence, are acting as our investment manager right now. If we wanted to withdraw out of RBIF because we didn't like how their asset allocation plan looked, or then what I'm saying is, right, you can either use RBIF or have your own investment manager.
Well, with RBIF, we get the mixture of bonds, foreign, and U.S. stocks.
Yes,
So we have exposure to stocks.
yes,
And then Buckhead is simply going to come up with some ideas with government agencies or something like that, if those have a higher return.
for the matching account.
Yeah. And if we chose, part of these could go into the matching account type
Or-
suggestion from Buckhead.
Or just a separate fixed income excess money sub-account.
Ah, very good, thank
right?
you.
And so, right, as you can see there under decision, we could fully withdraw from RBIF, either if we felt like, we don't like their asset allocation plan and their mix of stocks, or if we said, man, it's getting really frothy, this feels like a bubble, I just want to take my chips off the table completely and get completely out of the stock market, right? We've had a good run, right? We've got more than 20 million of excess monies. Maybe from a risk tolerance standpoint, I'm good. I'm gonna cash my chips in right now. We could do that. And then Buckhead could manage that fixed income portfolio in the excess monies account. Yeah.
And those were decisions that we discussed a lot last year.
They were, and that was part of the premise of withdrawing as much as we did out of that RBIF account, is if we have enough to cover the hard cash outflows we do, why would we continue to incur that risk? So this is somewhat a continuation of that. I think it came up before, and I didn't answer it completely effectively before, in terms of rising medical costs and inflation. Our actuary uses assumptions that are common, right, for other clients like ourselves in terms of projecting medical inflation. So I think there was a question before, maybe it was Alex or someone who asked about that. How do we keep up with medical inflation? And I forgot, somewhat unique to the school district, we actually cap subsidies we provide based on the growth of our general fund revenues. So it is not a unlimited increase one can see in our costs. If medical inflation go up 10%, but our general fund revenues only go up 4%, our subsidy amount can only go up 4. And so that's kind of unique to most agencies' OPEB liabilities. Like at the county, they don't have any kind of revenue cap like that. So it's an unlimited exposure to inflation. We actually have that revenue cap on what the district has to pay in terms of an eligible employee's subsidy. I had never seen that before until coming here. So that helps to certainly contain our liability. So all those factor into this decision. I mean, you know, one of the issues I think I've tried to identify here, maybe I did, maybe I didn't, is that, you know, we kind of have our own fixed income exposure over in the matching account. Why would we need fixed income exposure through RBIF, right? If this is the amount you're gonna let it ride, then just let it completely ride in stocks, if that's where you wanna be. I don't know if that makes sense to you, what I'm saying, but the RBIF account, saying it another way, the RBIF account is really for entities who haven't done what we've done. It's just kind of a one-size-fits-all for OPEB trusts that gives them some exposure to stocks, but as a blended portfolio to hopefully, right, diversify. You know, we've gone beyond that now, so that asset allocation may not work for us going forward. But again, not to beat a dead horse, until we cross over 100 million, I've got to go to the state committee and ask for approval. I'll be honest with you, there are some difficult times for school districts right now, and the Committee on Local Government Finance, for example, earlier this month, brought Douglas County School District to its committee, and they're struggling mightily and financially. I don't know if you've seen any news stories about it. They've run out of money, basically. So I do wonder how the State Committee on Local Government Finance would look at any increase in risk that a school district right now would propose to them that might feel a little tone deaf to them. So there's that. In other words, what I'm saying is I can't guarantee they would approve it. Right, even though our situation's completely different than Douglas or others, and we're talking about OPEB assets, not district assets, but, you know, things can, exactly, yeah, things can get blurred, so.
This is Alex Taylor. Is there any type of window that, I would personally not be in favor, most likely, or it might take some more convincing to try and go and ask for special permission while we're below 100 million. I think my feelings would probably change north of 100 million. I guess my first question is sort of related to the likelihood of passing 100 million.
Yeah.
First of all, you know, we have a heavy fixed income allocation, you know, with the matching program, and then we have outflows. It might be in the packet, but, you know, I'll ask the question, is there a point at which that outflows would be too much to overcome, if that makes sense? That, you know, if 26, 27, 28, if we haven't crossed 100 million, that because of projected outflows, we'd have a hard time ever crossing 100 million.
Oh, I see what you're saying. That's a good question. That could happen. Yeah.
Okay.
Yeah, that could happen. We could model that, I think, and kind of give you what would the break-even return have to be to, right,
Okay.
overcome the withdrawal of 5 million a year, basically. That's a really good point.
Okay. Second sort of corollary question, if we were to aim for, you know, our own asset allocation, you know, actually, I think I'll maybe just save it as a comment. If we were to go with our own asset allocation, I guess my feeling is, you know, you asked the question previously, and to the extent this is a discussion, would we ever want to take our chips off the table? My personal feeling would be we already have a pretty conservative allocation, so that would be excessively conservative. You know, to the extent we have capital that can be invested, I would think that we'd want to stay in the equity market, at least to some extent. Right now, if you were to look at sort of across the entire portfolio, what our asset allocation is, you know, it's the very, you know, what would it be? Probably 15-20% to equities, if that, overall. So, you know, that would be taking it to an exceptionally conservative place.
Yeah.
That I would personally view as unnecessary. My view would probably be, though, however, over 100 million, there's room to take on a little bit more risk with different asset allocation, different instruments that we don't have exposure to, that would overall, financial theory would suggest, would actually enhance our risk-adjusted returns. So I'm in favor of keeping an eye on that 100 million, potentially acting quickly if we were to cross it, especially if we were fearful that it would be depleted due to ongoing, you know, expenditures. If we were to have our own asset allocation, if we went above 100 million, and then due to market movements, expenditures for retirees, et cetera, and we went back below 100 million, are we grandfathered in at over 100 million, whatever asset allocation we want?
So I have general counsel here, but and so they may have a view, but I think as long as we're over 100 million, if we make an asset allocation, like what's, you know, offered here are options, we'd be okay. But so as long as we make those decisions while assets are over 100 million, we don't have to go back to the state committee, or we don't have to go to the state committee on local government finance. If we dipped below 100, I would think, and then we wanted to make further asset allocation changes, I think then we'd have to go to the committee. But we wouldn't have to, like if we went below 100 million, we wouldn't have to reaffirm with the committee the decisions we made when it was over 100 were, you know, they concur with.
Okay.
Yeah. I do have a question for general counsel, though. So next meeting, when we come back, when this is a decision, you know, when we want to make a decision here, and maybe not that we need an answer today, therefore, but could this committee make a recommendation that, right, in the future, once we cross 100 million, we're going to do this? So that kind of having trigger language, right, to say, if this happens, we're going to do this. Can we make a motion like that, or would we have to wait till we actually cross 100 million to make that asset allocation change?
I'm going to give you maybe an off-the-cuff answer
Yeah.
with an admonition that I'd like to research it and look into
Right.
it. But, I mean, I think this committee could take action on something like that
Okay.
to have an
Like a
automatic trigger in
yeah,
place.
a conditional kind of asset allocation.
Exactly.
Yeah.
I mean, I can't think of a open meeting issue or a other regulatory issue that would prevent that from doing that, or even a board governance issue with how this committee is set up. But I'd like to look into that issue before we,
Sure.
yeah.
Okay. Okay. Good discussion. Any further discussion on that item?
Mary Lamont, when you were talking about a cap,
Yes,
is that a cap on how much money goes to the retiree?
yes.
So if the cap is $100,000 and they go 100,001, the insurance doesn't pay for it? Is that what that means?
It's a cap on the subsidy amount, and so I don't get a subsidy and never will. So I don't, if I'm using goofy numbers, forgive me, but if your subsidy on your monthly health insurance was $200, what I'm saying is that is a formula capped amount. So that $200, if general fund revenues go up 4%, then, right, the subsidy would go up 4% or $8, but no more than that. So it's just it's an annual calculation and cap of what your subsidy amount is for that year.
And that's the money that I would get for my medical. Okay.
Yeah, and I don't know, I think you go through PERS, right? Isn't that, anyhow, it depends on which,
I'm not on that, so I
okay,
don't know.
so it depends on which plan you're at, but basically it's a cap on the subsidy amount you receive, yeah. Okay, there are a few other annual requirements, and we'll revisit them at our next meeting. And I think this worked out to have this discussion so that we can bring you back some analysis and then make a decision next meeting. But the other requirements are, and this is kind of oddly worded, and just remember, like a lot of state law, it's just somebody took a shot at drafting a law, and then, you know, it's there for the next 50 years, whether or not it makes complete sense or not. But we're tasked with doing a formal evaluation of the role or potential role of passive or index investment strategies, and the strategies to minimize cost administration of the fund. So again, I think this applies if someone was in the stock market outside of the RBIF account, this would come into play. We are not, right? So the RBIF account, again, is passive, low fee plan, but we don't, right now we have no choice, right? For our excess monies account, we're constrained to RBIF. So it doesn't apply to RBIF in terms of the matching liquidity accounts. We've kind of reported to you here the fees charged by Buckhead Capital. We do get a break on those fees from what the district pays Buckhead Capital for management of its fixed income portfolio. This is quite a significant discount based on, again, kind of the set it and forget it portfolio that we set up with those strips. So I'm reporting to you what their fee is. There might be one or two companies with a lower fee, but, you know, when we've gone out to request for proposal process, we think there's a really good, extremely good value for the fee Buckhead charges versus their expertise versus those other firms. So just reporting to you on that. And then the next requirement, again, is a review of investment-related practices, services provided by brokers, and unconventional investment strategies. So we don't use brokers directly to make investments, nor do we have anything we'd call unconventional. So that really wouldn't apply to us either, but we're supposed to do this annually. So that concludes the presentation. I heard a few items for additional analysis that we can bring back to you at our next meeting. Again, this was styled as a non-action item, so it won't take any public comment or votes. Is there anything else, though, that you all would like us to look at or that would help you assess anything here?
This is Alex Taylor. I think it would be helpful to know that if we were to cross 100 million, and I think until that day comes, my view would be let's stand pat. But if and when we were, it probably would be appropriate to further diversify our equity exposure into other asset classes. And I guess, given that it could be a window that wouldn't necessarily stay open forever to take such action, we should probably think in advance about what those options are. I think overall, were we to do something, I would strongly, most likely favor remaining in very low-cost investments, index-like. There's probably a role to, there's probably a scenario where staying in RBEF and supplementing just less and supplementing with other instruments might make sense. The question would essentially be twofold: which instruments and how to accomplish that, and try and remain somewhere close to an efficient frontier. And I think that probably requires a little bit more expertise or guidance than is currently on the committee. So the areas to think about, to try and be thinking about to be ready would be, number one, which asset classes, and number two, who or how would help us implement a strategy that might be a little bit less vanilla, let's call it, than the S&P 500 and a little bit of international and some fixed income. To me, I think it would make sense to have a portfolio that, instead of, the S&P is a large cap, and that's why it's a large cap index. That I think it's why traditionally it's been very, it's a very conservative approach to load up on the S&P 500. Also, market conditions have changed a little bit, such that the S&P 500 is concentrated in 7 stocks for about 30 to 35%. So, there are different approaches, and if you go back to performance, that's been a winner for 15 years or longer. And so on one level, we're sticking our neck out a little bit by changing. On some level, we're also sticking our neck out by remaining very heavy for our equity exposure into the S&P 500. And, when there are other instruments that we could be considering, even if we just wanted to stay large cap, you could switch to an S&P equal weight, something like that. That would take 35% concentration down to, it's 5% or less, much less equal weight. So if we wanted to do more all cap or introduce something like emerging markets, we're not going way out on a limb right there, but how to implement that, what type of advice, and even just, the basics of how to what the specific asset allocation we'd be looking for. Reasonable minds around this table could disagree. I think we'd want a little bit of guidance on, either what staff thinks or where we could find sort of a low-cost asset allocation model that we could tweak to our specific risk tolerance on the committee.
And so, along with that, we'll hear from general counsel here on whether we can make a conditional recommendation like that, because I agree with you, it's likely going to be a, window we have. So we can consider that. We can bring some options back to the committee. I think our next meeting is probably March. So we can do that, which might be our window. So, any other questions before we go? Okay. So I've lost track of the agenda, but I believe that is our last agenda item. And so thank you very much. Happy, oh, I'm sorry, public comment. Thank you.
Announcing
Thank you.
comments, and then 3.01 is public comment.
Yep. And then, okay. So I'll take any public comment. Come on, you guys. It's your last chance in 2025. Thomas. Okay. Seeing no public comment, our next meeting is March 19th of 2026. Hopefully we'll all see you there. In the meantime, happy holidays to all of you. And we are adjourned.